iHeartRadio as well. And we have a tremendous program for you today. And you can download our past podcasts as well on iHeartRadio and TalkShoe. We have got IQ, Al Rizzoli, the best-selling author, with us today. We also have the incredible Dan Perkins, or as a PR person likes to refer to him as, Dangerous Dan Perkins. And we have a financial and media analyst with us today, the editor of the Extreme Value, a monthly investment advisory that focuses on some of the safest and yet most profitable stocks on the market. He's also the host of the Stansberry Investor Hour podcast. The great Dan Ferris joins us today. You can get more information on investorhour.com. And so Dan Ferris, you have got this incredible topic today. Is Biden stepping into the second Great Recession? Tell us a little bit about this, and then we'll let the guys ask you some questions and grill you on this.
Actually, you know what, you guys, you're breaking up. I can hardly hear you. I'm so sorry.
Not a problem. I'll try to fix it on my end, my friend. So tell us about, is Biden stepping into a second Great Recession?
We don't know that, and we don't have to know it. We don't have to predict it. I doubt that he's going to be the cause of it if it occurs. But what he's doing potentially is setting a precedent that could get us back to a place we haven't been for decades, which is kind of bad inflation, in my opinion. We found out that QE, the Federal Reserve, et cetera, will not cause inflation by doing QE. But you can cause real inflation through these fiscal policies. If you print enough money and put enough stimulus out there, you will push prices up eventually.
Dan Perkins, jump in there, my friend.
Thank you. I've been managing money for about 50 years, and I've been through, I didn't go through the Great Recession in 29. I wasn't quite born yet, but I've been through every one since then. I would say that I have certain keys that I look about economic growth and inflation. One of the keys is the price of gold. It's down about $200 an ounce from its peak, and it's about where it was 2 years ago at around $1,800 an ounce. Number two, I look at the yield spread between the 90-day and the 30-year Treasury. The 90-day Treasury this morning was 3 basis points, effectively zero. Money market mutual funds are paying 1 basis point, which you can't count because it costs more money to print the check for 1 basis point than to get it. So that the Fed told us last week that they're probably on hold till 2022 to 2023. So the Fed's not going to raise interest rates. The Fed doesn't have much room to go down, and to create a situation where we may see negative interest rates that we saw in the last Great Recession in Europe, and even here for a while. I agree with you that the element of debt that we're putting on is a problem, and I think that's where Mr. Biden will in fact be responsible for creating the next recession, as he continues to spend like 4 drunken sailors and spends everything he possibly can. I mean, when you think about it, I wrote a commentary. I write for about 30 different blogs. Jim says I write for too many, but there's always room for one more. I just finished a commentary, and I said, if you look at the stimulus, the quote 2,000 that went down to 1,400 because Trump already gave him the 600. If you look at the poverty line in the United States, the government says it's about $23,000, $24,000. So a $1,400 stimulus payment won't even cover the monthly expenses for the poorest of us in the country. So that means one of two things. And I think it means we're going to see bigger and bigger stimulus payments to deal with that. The House is studying right now, I think between $3,200 and $3,600 cash payment per child as a stimulus. So I don't think that $1,400, $2,000 a month, or $2,000 is going to do anything to help overly stimulate the economy, because the people at the high end are not going to get it. The people at low end are not going to have enough to cover them for the next month. And what are they going to do in March? So there has to be a lot more stimulus coming, a lot more, much bigger numbers. And I think that that's what could, in your case, lead to a situation where we got the ratio of debt to GDP right now is more than 1 to 1, and it could go much, much higher. What do you think?
Well, that all makes sense to me. Look, we know that the more debt they bring on, and from this point forward, with the ratio of where we are versus GDP, from this point forward, bringing on more debt means it's less and less productive. It has less and less effect. And they've already come out of the gate with one, we came out of the gate with $2 trillion stimulus. This one is 1.9. If you want to really do that, if you want to keep doing this, you have to do more and more and more. It's the dynamic of an addict. So, but these things are no substitute for real economic activity. So you're right. What's next?
Right.
What's after March?
Well, I did, as I was writing this article, I did some research because I really wanted to find out if this 1.9 trillion goes through, plus the other, we're approaching $6 trillion of stimulus in the last 14 months that we have passed, but we've only given away half of it. So why are we adding another 1.9 billion when we still have half of what we appropriated before that still hasn't been distributed? And I think that there's a terrible deception game going here, and I'll help you understand what I'm saying. Biden has talking about we need this $1.9 trillion to protect the people and to attack the virus. Moderna and Pfizer both tell us that they're charging the federal government for the 2-dose regimen of their vaccine $40. If you take that Joe Biden says he wants to vaccinate 300 million people, you take 300 million double doses of the vaccine, and you wind up spending $12 billion. What I want to figure out is, what is the other $1.882 trillion for? And we can't find out. We don't know. I did find where there's 1.4 billion going to this country and $500 million going to the other country, but we don't know what it's going for. But billions and billions of dollars are leaving the United States and going to foreign nations for unknown specified reasons. So I think that he's not telling us the truth. He's not telling us what's really going on. And I suspect someday we'll find out just how much pork is in the $1.9 trillion.
Yeah, it's record pork would surprise no one in this. We know how they do these things. They pass them so they can find out what's in them, in Pelosi's popular phrase. And this will be no different. You're absolutely right. This will be no different, and it'll be, since it's 10 times bigger, it'll be 10 times worse. Absolutely.
So are you in the camp, not saying with me, but are you in the camp that they have no choice but to ask for more and more stimulus? And asking for more and more debt is what will ultimately create inflation against the currency and bring the economy down. Is that your scenario? Is that a fair assessment?
That is right about where I am, yeah. That's right about where I am. And we
do you have keys that you...
Go ahead.
Do you have keys that you watch for like I do, or do you have different keys?
Well, no. No, I'm not. I'm not that systematic as you are about macro items. I don't trust most of these things to tell me what's going to happen substantially before it happens, and I don't think I need to as an investor either. I say prepare,
So,
don't predict. That's what my mantra.
so what would you be recommending your clients to be buying today?
Well, the basic framework that we've been working with for a couple of years now is what I would call real diversification or true diversification. Most people think they own stocks and bonds are diversified, and I would disagree with that.
Right. I agree.
The real diversifier, the ultimate diversifier in a real crisis is cash. Because all the rest of that stuff, all the models go out the window and the correlations all go to one, and your gold falls, your silver falls, your stocks fall, it all goes out the window. So if you don't have cash, enough cash, I don't think you can be said to be truly diversified. That's the first one. In addition to your stocks and bonds, don't sell them all and head for the hills, right? You want a stake in continuing growth and continuing innovation. You don't want to get rid of that, but you want plenty of cash. You also want something which I would say is relatively outside of that regime. Gold, silver, even Bitcoin a little bit wouldn't hurt you. And then I also encourage my readers to make it personal. Figure out what you know something about, maybe that other folks don't know. I mean, I heard one guy, he learned all about investing in whiskey in casks in Scotland and this sort of thing. So there are different ways to allocate capital that can be a lot more personal in that regard. And then that other framework is my basic framework. And we've recommended equities. We've recommended stocks like, Constellation brands. People aren't drinking in restaurants, but they're drinking just as much. They're just doing it at home now. So that on-premises demand, shifted into the home. Things like that.
So if you look at your portfolio, let's just say that a person had a $250,000 portfolio. In your mind, what percentage should be in cash?
At this point, 20%.
Okay, I'm a little more conservative than you are. I'm 25 to 35, but that's okay. We're close.
Yeah, I've established 20 as a minimum, so just put it that way.
And are you more inclined to do bills or commercial paper or what?
I would be more inclined to do bills. I'm not inclined to do commercial paper. You don't want, at least with the bills, you don't get counterparty risk and that sort of thing.
Absolutely. And you got the ultimate, whatever it's worth, a full faith and credit guarantee of the government.
Whatever it's worth. Exactly. Yeah. It's a lot more liquid.
Do you think that a lot of people, we had an incredible year in 2020. We saw the market collapse, hit bottom on March the 9th or 10th, and then roared not only all the way back to where it was before the pandemic struck, but went way above it. So we didn't have a lot of fear selling because it was so quickly to respond. Do you think people have too much risk in their portfolios today?
Well, I have to answer probably yes. When you see, you just see some of these crazy things that we've seen in the press, the GameStop episode, or even a stock like, just pick one, like Riot Blockchain or something like that. I mean, those charts are ballistic missiles. They're straight up. And, that's not rational. It's not reasonable.
So you raised an interesting point when you talked about GameStop. I have been in this business for 50 years, and I've traded stocks all over the world, and bonds all over the world, and commodities all over the world. And I look at what happens, how institutional investors, long and short hedge funds, just pound the hell out of a stock because they've got a short position and do everything. I won't mention the name of the stock, but I saw a research report this morning that was full of, well, I'm not sure, maybe it could be, but I wouldn't count on it, the kind of stuff with a company that just blew away earnings. But my guess is they were probably short. So the GameStop, I thought that the GameStop issue, and I saw this article yesterday where this 21-year-old kid put $100 and wound up making $200,000 in a GameStop trading. What happened was, to me, is that we had a revolt by individual investors against institutional investors, and the institutional investors didn't have enough money to fight off the individual investors. Is that a fair assessment?
I think that is a big part of what happened. Yes, it was a classic short squeeze. You know, and the other narrative, I think, you know, you can read things on Reddit that say pretty much exactly that, but you know, I think part of it too. Look, I hate to paint things with a too broad a brush, but you know, the folks on Reddit buying GameStop and paying $100, $200, $300, even $400 for it, you can't say they know what they're doing. You just can't, right? Mm-hmm. And the folks in you know, Citadel or wherever else, Melvin Capital, who are shorting the thing, are probably right about it, right? They sold the AT&T stores. The rest of it is just not worth that much, and it's probably going to zero at some point. It doesn't exist. So, you know, one day these Reddit people get together and they say, "Oh, this stock is cheap," and it's gone up a bunch already. And Mike Burry liked it, and here it was $3, and now it's $6, and now it's $12, and they get into a frenzy. And by goodness, they have enough money to shove the thing around because it's only got a few $100 million in market cap. And before you know it, it's worth $12 billion because Melvin Capital is losing 53% in 1 month, and all the rest of them. So it was crazy. And you see where it is today, though, right? I mean, it's just.
I didn't see. I haven't seen it today yet. What?
Last time I looked at it, well, it wasn't today. It might have been yesterday. It was $50 or something from a 52-week high of 480. So, yeah. And when I see things like even, you know, Riot Blockchain is just kind of a company that lots of people are excited about because it has the word blockchain in it. And the same ballistic action in a stock like that, look, we know how this ends. It doesn't go up and then sideways. It goes straight up and it goes straight back down. And the more of these you see, you know, the toppier it all feels to me.
So when you look at charts and you look at stocks that have gone up 600% or something since the first of the year, you take a GameStop, but one area that has really exploded in price appreciation are the green energy stocks. The green energy ETF funds are buying them like crazy because the belief is that Joe Biden is going to do a lot of damage against the fossil fuel industry, and alternative energy companies are perhaps undervalued in what they could be doing as we change the economy from a fossil fuel to whatever green means.
Right. So you have to ask yourself how much real growth is baked into any one of these stocks or all of them together. How much of that is just people rotating to the next thing you get excited about. And to me, it looks like that, you know, manic, toppy rotation type of a thing. However, there are real questions here, like in 20 or 30 years, how much renewable are we going to have? I mean, I personally, I'm not crazy about renewable technologies. I think they're really sloppy and kind of dirty. Solar panels are made of toxic waste. You want to carpet the landscape with toxic waste? I don't get it. But a lot of other people seem to be buying them. You know, utilities buy them and they get credits for it. So there could be something real here, and there could be this manic moment now. You know, just think of the internet. It was crazy in 1999 and 2000.
Absolutely.
Then it all washed out over, 20 years, and the real businesses came to light, and all the frauds went out of business, and the duds and the zeros.
Right.
And a lot of these things, the blockchain thing could wind up that way. It's crazy now. In 10 years, whatever's valuable might be left. It might be really cool. And the same thing with renewable. It's crazy now, but in 10 or 20 or who knows, 50, I don't know, years, whatever's really valuable might be left, and you might do well to try to figure it out as soon as possible.
I heard this story this past week, which shocked me. You might have heard about it. The propellers on the windmills are not recyclable. They're being buried in Wyoming. They can't recycle them. They have to bury them to get rid of them.
Right. And you know, in the first place, they're made of steel, which of course is an alloy of iron and carbon, you know, coal and iron. So, you know, the whole thing gets a little weird. And even just electric vehicles is another one, you know. I think we're probably going to be driving a hell of a lot more electric vehicles in 10 years. But that's a little crazy too, isn't it, with Tesla?
I saw this interview by the Assistant Secretary on Energy Policy for the Biden administration last week. And she was talking about electric cars. And the reporter, they were standing in front of a Tesla car. And so the reporter said to her, "So where does the power come from to charge the battery?" And she says, "In the wall."
Yeah. It comes from the wall.
It comes from the wall. And so he asked her another question, and she said, "Well, where does the energy come out of the wall from?" And she said, "I think the county government." She wouldn't admit that the energy that's charging the battery in the electric car is either coming from coal or natural gas power plants.
Right.
And either she was stupid or refused to answer the question because she knew that she was putting herself in a very awkward position. And, you know, the other issue that, as we talked about the windmills, the blades, in electric cars, in a Tesla, the cost to replace a battery is $25,000.
Sure.
That's a hell of a spare part. And on top of that, what do you do with the battery once you take it out of the car? How do you dispose of it?
Right. That's the one that kills me because of all this. You know, they're claiming it's all environmentally motivated. And the fact is that it's real hard to figure out any kind of way to make anything that doesn't have some waste associated. The universe just doesn't work that way.
Right. So what is your outlook for 2021 for the markets? What do you think is going to happen?
Well, again, I'm not a predictor. I'm a preparer. And I would say prepare 2021 and even beyond for a continued sort of wider range of outcomes. You know, prepare for higher volatility in most asset prices, especially equities and bonds. Lots of volatility in both of those. And like I said, be truly diversified because that's I think that's more important than ever. I really do.
Jim, how much time do we have?
I believe we've got a little bit more time here with Dan, but before he's got to go. So you've got like one or two more questions here.
I'll just ask one more. There's something that's going on that I don't understand, and maybe you can shed us some light. For some reason, the mainstream American media has forgotten what's going on in the rest of the world. I mean, when's the last time you heard a report about COVID-19 in England or France or Germany or South Africa, other than to say that the South African virus is the AstraZeneca drug apparently is not going to work against it. So now they're scrambling to try and figure out how the reconfiguration. But what do you see happening in the rest of the world?
In the rest of the world, well, that encompasses quite a bit of territory. But really, essentially, the question is ex-U.S. right? So what do you do about with your money that involves something outside the U.S.? And I say, this is actually a decent time to look at things like, traditional emerging markets, even emerging market debt, things like that. I don't have any specific picks on this right now. We're just sort of, we tend to have a U.S.-centric audience, and we rarely recommend securities outside the U.S. But I think for the first time, we're probably looking at markets outside the U.S. other than Canada or London that we've recommended in the past, simply because that's where the better value is, frankly, overall. Okay. The U.S. has been the only alternatives, it seems, for years now. And that idea is getting overdone, especially with all the things we're talking about that Biden's doing and what that means for the situation fiscally. And I don't believe you can any longer just be, like Warren Buffett says, you don't need to go outside the U.S. I don't think that's true anymore. I think you do.
Thank you so much for your insight.
Yes. But before we let you go, Dan, IQL Rizzoli, do you have any questions for Mr. Ferris while we have him here?
Are you serious? I enjoyed the conversation, listening to both of them. I don't have enough money to spend and buy, and so I'm very comfortable where I am. It's a pleasure listening to you. Thank you.
Well, Daniel Ferris, before we let you go, how do we get all your material, the podcasts, and everything else, my friend?
Yeah, the best place to find me is at the Stansberry Investor Hour podcast. InvestorOut.com is the place to find me there, or StansberryInvestor.com. You can also find me there.
Fantastic. Well, you have been a treat today, my friend. Just listening to you and Dan go back and forth, that this is exactly why I booked you on this program.